It was the 14th of October, 1997. In Stockholm, a committee was writing two names onto the Nobel Prize in Economics. 11 months later, those same two men would be sitting in a conference room at the New York Federal Reserve, watching 14 of the largest banks in the world decide whether to save them or let them take the financial system down with them. This is the story of long-term capital management, a hedge fund founded by the best bond trader on Wall Street, advised by two Nobel laureates, staffed with the smartest men in global finance. $4.6 billion lost in under 4 months, $3.6 billion injected to prevent a wider collapse, and one question that finance has never quite answered since. What does it mean when the genius fails? In February of 1994, John Meriwether opened the doors of long-term capital management in Greenwich, Connecticut. He was 46 years old. 3 years earlier, he had been the vice chairman of Salomon, Salomon Brothers, running the most profitable trading desk on Wall Street, the fixed income arbitrage group that was, by 1990, producing over $500 million in annual profits. He had left Salomon in August of 1991 in the wake of the Paul Moser Treasury auction scandal, not personally implicated, but responsible as Moser's supervisor. By 1993, he was recruiting again, and the men who followed him out the door became the founding partners of LTCM, Larry Hillerbrand, Salomon's highest paid trader, Victor Hagani, who ran European arbitrage, Eric Rosenfeld, Greg Hawkins, Dick Leahy, and two men who weren't from Salomon at all. Myron Scholes, co-author of the Black-Scholes option pricing formula, the single most important equation in modern finance. Robert Merton, who had extended that formula into the framework every derivatives desk still uses, and later, a former vice chairman of the Federal Reserve, David Mullins, who had stepped down from the Fed in 1994, specifically to join them. This was not a startup. This was a cartel of intellect. $1.25 billion in investor capital on day one, a minimum investment of $10 million, 3-year lockup, fees higher than anyone else in the industry, 2% on assets, 25% on profits, when the industry standard was 2 and 20. The logic of these fees was simple. This was the best team. You paid to be in the room. 1994, 10 months of trading, net return, 20%. 1995, 43%. 1996, 41. By the end of 1996, LTCM managed $7.5 billion in investor equity and nearly $150 billion in positions. The numbers were not just good, they were unprecedented for a fund of this size. The strategy had a name, convergence arbitrage. Two related bonds traded a stable spread because the logic of the market should link them. Italian government bonds and German bonds. On-the-run U.S. Treasuries and off-the-run U.S. Treasuries. Danish mortgage bonds and the swap curve that priced them. The spreads moved by a few basis points. LTCM bought the cheap side, sold the expensive side, and waited for the logic to reassert itself. Each individual trade offered almost nothing. A few hundredths of a percent of edge, but leverage multiplies edge, and long-term capital was levered roughly 25 to 1. Myron Scholes described the strategy in a phrase that would later be printed on the wall of every business school, vacuuming up nickels that others couldn't see. Behind that image was a second phrase, less flattering, picking up nickels in front of a steamroller. Victor Hagani used it. So did everyone who understood what arbitrage actually was. In October of 1997, while LTCM was mid-cycle, the Royal Swedish Academy announced that Myron Scholes and Robert Merton had been awarded the Nobel Prize. The prize committee cited their work on derivative pricing. No footnote was required. Their firm was up 17% for the year. And then in the fourth quarter of 1997, long-term capital did something that would look, in hindsight, like the beginning. It returned $2.7 billion to outside investors, nearly a third of the fund's capital. The stated reason in a letter from Meriwether was that investment opportunities were not large and attractive enough to deploy more capital. The positions were not reduced. Only the equity was. Leverage silently increased. The first red month was May of 1998, a small equity arbitrage position, a bad week for merger spreads. Then June was worse. Then July. On the 17th of August, 1998, the Russian government devalued the ruble. It declared a 90-day moratorium on foreign debt payments, and it defaulted on domestic government bonds. The GKOs, GKOHZ, and OFZZs, worth approximately $13.5 billion. LTCM was long Russian debt, but that was only the direct exposure. The fatal part was everywhere else. On August 21st, 4 days after the Russian default, something happened that the fund's risk model had rated as impossible. The model, calibrated on 5 years of daily data, considered a loss of $35 million in a single session to be a 1 in 10,000 event, a 5 sigma day. LTCM lost $553 million that day, more than 15 times what the model considered the maximum plausible loss. And the reason was not that the models were broken. The reason was that every counterparty on Wall Street was holding the same positions. When Russia defaulted, every one of them tried to reduce risk at the same time. The spreads LTCM believed were diversified moved together because the same banks were all hedging the same way, all at once. Correlation, which the model had assumed was around 0, became 1. By the end of August, LTCM was down 44% for the month alone. Equity had fallen from $4.7 billion on the 1st of January to roughly $2.5 billion at month end, almost half the fund, gone in 31 days. On September 2nd, Meriwether wrote a 4-page letter to investors. The tone was calm, almost clinical. He admitted the losses. He invited new capital in at what would now be a discount. He described the position as recoverable. It was not recoverable. By the 1st of September, equity was $2.3 billion. By September 22nd, $600 million. In 6 weeks, a fund that had been valued at $4.7 billion was holding positions worth $125 billion against $600 million of cushion. The leverage ratio, which had been 25 to 1 on New Year's Day, was now over 250 to 1. On Wall Street, word was spreading. Bear Stearns, which cleared LTCM's trades, demanded additional collateral. The banks that had lent to LTCM began to model what they would lose if the fund was forced to liquidate. The numbers were worse than anyone had imagined. On the 18th of September 1998, John Meriwether placed a call to William McDonough, the president of the Federal Reserve Bank of New York. McDonough dispatched a small inspection team to LTCM's offices in Greenwich. Executives from Goldman Sachs, Merrill Lynch, and J.P. Morgan. The 3 firms the Fed considered to have the most direct knowledge of the fund's positions. They spent 3 days reading through the book. What they found would shape the next 10 years of Wall Street. $1.25 trillion in off-balance sheet derivatives. Every major investment bank in the world on the other side of some piece of it. If LTCM failed in a disorderly way, the unwinding alone would move the most liquid markets on Earth. On the morning of September 23rd, from an Alaska trip with Bill Gates, Warren Buffett made a phone call. The offer, assembled by Berkshire Hathaway, AIG, and Goldman Sachs, was direct. Berkshire would put up $3 billion, AIG $700 million, Goldman $300 million, $250 million of that total would buy out LTCM's partners from their own creation. The remaining $3.75 billion would recapitalize the fund. Buffett gave Meriwether under an hour to accept. Meriwether refused. His public reason was procedural. He was, he said, legally unable to consent without consulting over 100 outside investors. By 12:30 in the afternoon, the offer had lapsed. That afternoon, at the Federal Reserve Bank of New York, William McDonough convened the chief executives of 14 of the largest financial institutions in the world: Chase Manhattan, Goldman Sachs, Merrill Lynch, J.P. Morgan, Morgan Stanley, Credit Suisse First Boston, Deutsche Bank, UBS, Barclays, Bankers Trust, Paribas, Societe Generale, Salomon Smith Barney, Lehman Brothers. Bear Stearns, invited as LTCM's clearing agent, refused to contribute. So did Credit Agricole. The remaining 14 put up $3.625 billion in exchange for 90% of the fund. The deal closed at roughly 6 p.m. Alan Greenspan, testifying before Congress a week later, defended the intervention. His phrase, which would be quoted for the next 20 years, was that without it, substantial damage could have been inflicted on many market participants. The Fed had not lent a dollar of public money. It had provided a room and the convening authority of its logo. But the precedent was set. In early 2000, the fund was fully unwound. The consortium was repaid in full. The outside investors who had stayed in through the crisis received back only a fraction of their 1997 capital. Step back from September of 1998. The LTCM episode was not the first time a single concentrated trade had threatened a wider financial system. In 1890, Barings Brothers, the bank of the previous episode, faced bankruptcy over its Argentine positions. The Bank of England organized a private rescue, with Nathan Rothschild's firm and the Banque de France providing emergency funding. That rescue saved a single bank. 105 years later, a different Barings collapsed, and there was no rescue. What was different in 1998 with LTCM was that the problem wasn't a bank at all. LTCM was a hedge fund. Under U.S. law, it was structured as a private investment partnership, exempt from the Investment Company Act, exempt from leverage caps, exempt from most SEC registration. It was supervised by nobody. And yet, in September of 1998, the U.S. Central Bank concluded that its failure would threaten the global financial system. The implication was simple and new. A firm could be too large to fail without ever being a bank. Systemic risk, in other words, could walk in the front door of an institution nobody was watching. 10 years later, in September 2008, Lehman Brothers was allowed to fail. AIG was rescued. Bear Stearns had been rescued 6 months earlier. The intellectual framework those decisions rested on: who is systemic, who is not, what counts as too big to fail, was the direct descendant of the judgment made in room 10C at the New York Fed on the 23rd of September, 1998. The regulatory response to LTCM arrived, as it usually does, with a delay. The President's Working Group on Financial Markets published its report on hedge funds and leverage in April of 1999. Basel II, which incorporated operational risk capital charges, came into force in 2004. Dodd-Frank Title VIII, which allowed regulators to designate non-bank financial institutions as systemically important, was passed in 2010. Each of those frameworks cited LTCM by name in its foundational documentation. And yet, when the next crisis arrived, in 2008, the leverage inside the largest investment banks was roughly the same, 30-1, that LTCM had run with in January of 98. The convergence trades had moved from hedge funds to proprietary desks. The Nobel Laureate design risk models had become industry standard. The correlations that had gone to 1 in 1998 went to 1 again in 2008. And the final bill, instead of $3.5 billion, was measured in trillions. Former Treasury Secretary Larry Summers observed later that the LTCM bailout established expectations that proved destructive 10 years on. That is one view. Another, held by Alan Greenspan, is that the alternative, disorderly liquidation of a $1 trillion derivatives book in September of '98, would have been catastrophic. Both views can be correct. Neither answers the question at the center of the episode. Two Nobel laureates, 30 years of continuous time finance theory, the most diversified arbitrage book ever assembled, 25-to-1 leverage that everyone, including the Fed, considered manageable, and a system in which, when a regime change comes, correlations between every supposedly independent trade go to exactly 1. Is the lesson that the models were wrong, or that we have no way of running a system this complicated without eventually needing a room at the Fed? On the 14th of October, 1997, the Royal Swedish Academy awarded the Nobel Prize in Economics to Myron Scholes and Robert Merton. On the 23rd of September, 1998, 344 days later, they were named in the consortium agreement at the New York Federal Reserve as partners of the failed fund whose bailout had just been signed. Meriwether relaunched in 1999 as JWM Partners. It closed in 2009 after another 44% drawdown. He's in his late 70s. He is still trading. The 14 banks were repaid in full. Bear Stearns, which refused to contribute, went under 10 years later. Lehman, which contributed $100 million, filed for bankruptcy in September of 2008, almost exactly 10 years after the LTCM deal. $4.6 billion, 4 months, 2 Nobel laureates, 1 room at the Federal Reserve. Next on Legends of Markets, 1992. A different kind of trader and a currency that a central bank could not defend. Subscribe to stay with us.